Ladies and gentlemen, our research has focused on how does climate risk affect bank efficiency. In 2023, the US experienced 28 climate disasters, resulting in $92.9 billion in economic losses. And this number has surpassing the previous record of 22 disasters in 2020, according to National Oceanic Atmospheric Administration. While climate disasters can lead to economic disruptions, rising public debt, and inflationary pressures, threatening long-term stability. While banks play a significant role in our financial system, so understanding how that climate risk impacts bank efficiency is increasingly important for financial institutions and decision makers. And we found that prior studies focus on how climate risk impact on cost of bank loans, systemic risk of banks, and bank liquidity. However, bank efficiency as a whole in response to climate risk exposure remains underexplored. So this study investigates the relationship between climate risk exposure and bank efficiency in the US from 2011 to 2021. And we use fixed effects panel regressions for robust estimation. And our main findings suggest that climate risk has a strong negative effect on bank efficiency. Our first model suggests that the climate risk has a strong negative effect on bank efficiency. As you can see in the first column, the CR represents climate risk, with a correlation with the bank efficiency reached the negative 13.8 degree. And we also find that bank size, loan ratio, return on assets, and loan loss provision ratio increase bank efficiency. And if you see in the bottom, the R-square range between 83% to 85% of the variation in bank efficiency, indicating that our model has a strong explanatory power. And we also have supplementary findings. We consider the type of banks, whether it's commercial or non-commercial, and the size of banks, whether it's large banks, medium banks, or small banks. And we found that non-commercial banks are more vulnerable than commercial banks. And climate risk has a negative and significant impact on banks regardless of its size. And small banks are the most vulnerable to climate risk. And we also consider the liquidity and capital size and profitability of banks. And we all find negative relationships between them. And our results show that climate risk significantly reduces bank efficiency with a consistent and substantial effect across different specifications. And our findings have important implications for risk management practices and regulatory policies.